Now, Anna has a wealth of experience working for different companies, including the Sovereign Wealth Fund of South Korea. And she's going to be talking about the private credit space on today's webinar. So you might have heard a bit about it in the news. It's a very fast growing segment of the investing market. Some football clubs even are using it as collateral for transfers. And you might have seen all kinds of news about it in the past. Even Mark Carney, the former Bank of England chief and current Canadian Prime Minister, used to work for a company in the space. So it's quite an interesting avenue and space. So I'll hand over to Anna for the presentation.
The returns in the next 10 years in public markets might look very different to how they looked in the past 10 years, meaning the returns we've had in public markets in the past 10 years may not be as repeatable in the next 10 years. And so this is just one piece of research that's showing the expectations for the various asset classes for the last 10 years, 5 years and 5 years in this one. The next one we'll be talking about a broader kind of time period in terms of diversification and asset class expectations. But the key message here is that investing in public markets alone may not be sufficient to achieve the target returns for an investor. This chart is particularly interesting, produced by Callan Associates, who are a think tank focused on investment management, who looked at what it would take for an investor to generate a 7% return consistently. In the 90s, it was sufficient to invest in government bonds. In the early to mid 2000s, one had to add exposure to public equities to get that balanced return. And today, that's no longer enough. I think in light of where we are with the asset valuations on the public market, one needs to start considering private markets and adding the various private markets asset classes to achieve that balanced return for sustained growth. And so finally, to sum it all up, so again, why should one care and allocate to private markets? Now, the primary reason is the potential for return enhancement. Historically, private equity and the related asset classes have outperformed private public markets over longer time horizons, in part due to the illiquidity premium and the active value creation strategies. They also can offer important diversification, as the returns are less tied to the ups and downs of public equity and bond valuations. And for sophisticated investors, they can also provide access to unique deals and sectors often not available in public markets. Now, one needs to consider these advantages, looking at also some of the complexity and illiquidity, and also considering manager selection. But when incorporated thoughtfully, private market investments can improve a portfolio's risk-return profile. And finally, with the newer fund structures, some of the drawbacks of the private markets investing, such as the J-curve and illiquidity, are also addressed.